So now you have a party, a counterparty to the counterparty, all backed by an insurance company and the Federal Reserve as a last resort, all dependent on the belief among nations and institutions that the United States is creditworthy, the dollar is stable, and our leadership is sound. In other words, an entire economy built on faith. All right, so I'm back on the financial and economic bandwagon because there's something really important that people need to understand right now. Not because there's anything you can really do about it, but because the gaslighting has already begun.
Core GDP, and this is, you probably saw some numbers today, and I have to start off by saying that's Biden. That's not Trump.
More than a year ago, I said that Donald Trump would destroy the economy in a second term after I read Project 2025. But I actually thought it would take a full term to do it. Now it's pretty clear that it's going to take him about 6 months. What made me say that last year is that it was clear he was going to enshrine his original tax cuts while gutting entitlement programs and social safety nets. So eventually he would just break the working class and whatever's left of the middle class. But there was something else. My central critique of Biden's bottom-up middle-out strategy was that it would take 10 years to fully realize the benefits of it by design, and that those benefits would flow largely to the corporate class and that the working class was already in crisis. So it just wasn't adding up. But knowing that, at best, it would take 10 years to fully realize a return on investment from the Inflation Reduction Act and the American Rescue Plan, then the one thing that could derail it was Trump dismantling it all. And so here we are. What I didn't bank on was the Trump economic plan that lives outside of Project 2025, this whole tariff regime nonsense. Now, I've listened to every policy rationale they've offered, and I've come to the conclusion that this is the stupidest group of people we could possibly have in charge of the economy. The only funny thing is that even they're beginning to realize how badly they've screwed this all up. And now they're covering their tracks with yet another big lie, that it's all Biden's fault. Now, there are two things you have to do in order to sell a lie, something Trump has mastered. First, you have to believe it yourself. And second, there has to be a kernel of truth to it, no matter how small. So what's above the surface and just on the horizon is bad enough, and that's what we can see. But it's what's below the surface that has me really concerned. There's a crisis brewing in the financial markets that could be as catastrophic, if not more so, than the Great Recession. UNFTR. There's so much at play right now, and the temptation is to isolate certain data points to try and make sense of the global economy. I mean, I've done it before, even recently, by looking at ISM manufacturing data, labor participation rates, inventory stocks, core inflation, market inversions, and so on. So today, I just want to kind of take a step back and talk it out. I find narratives more compelling than charts and graphs anyway. But if you're interested in charts and graphs, Apollo Global Management just released a report that I'll link in the notes that basically shows how bad things are going to get and how the economy is going to come to a standstill by the summer. Now, for context, Apollo has a $500 billion under management. They don't exactly benefit by being a doomsayer. The only chart that shows anything positive, though you could argue that it's not, is that retail consumer spending has held steady thus far in 2025. The downside of that, though, is that credit risk is through the roof, which means people are buying stuff on credit and they're starting to pay late. Like I said, even the good news isn't all that good. Outside of that, their data show that new orders are collapsing in manufacturing while inventories are spiking. Now, part of that is a reflection of over orders to get ahead of tariffs, but companies are definitely bracing for impact. CapEx, or the amount that companies are planning to spend this year and next year, has plummeted. The price of goods for manufacturing is already spiking, so it's only a matter of time before the costs are passed through to the consumer. Every trackable confidence measure, from CEO to consumer, is in the toilet. The flow of goods from China has halted, which has already led to a 25% reduction in activity at the Los Angeles port alone. European travel to the United States is down between 30 and 40% depending on the country of origin. More than 10% of credit card holders are paying the minimum, a 2% increase just this year. Delinquencies are growing every month, and cash home purchases fell off a cliff just last month. So there's plenty of charts and graphs and data to blow your mind, but here's the overarching narrative theme. Through a combination of intention and incompetence, Donald Trump's administration is on a path to drive the U.S. economy into a 1930s level crisis, which will pull the whole world economy down with us. But, and this is a big but, his recklessness is an acceleration of a late-stage capitalist trend that has been building since the mid-1990s. Now, I know what you're thinking. You hear a lot of these kind of hyperbolic pronouncements about late-stage capitalism, the decline of the U.S. empire, the reordering of the global economy, an end to U.S. hegemony in the world. Big fancy concepts, right? For the most part, I think these kinds of academic conversations about systems and isms are lost on people. Not because they don't understand them, but because they just don't matter in the moment. Debating which stage of capitalism we're in is horseshit if you're late on your bills. Now, don't get me wrong, I live for these debates, but they border on mental masturbation if we're not having a pragmatic discussion about meeting basic human needs under the system that we have now. But I do want to make some of these bigger concepts more tangible because there are events on our doorstep that relate to them and involve everyone. So permit me to offer a simplistic take on a very broad theme to help explain where we are in the economic life cycle of U.S. capitalism. For political centrists or fans of capitalism, don't freak out, but I am going to start with the Marxist theory. It's called the total circuit of capital. Now, it's just a straightforward explanation of the capitalist system that shows how capital, or money, is used to purchase labor and machinery to modify a commodity into something productive that can be sold. The surplus value generating from this process, i.e. profit, goes back into the capitalist pocket to be reinvested, and the cycle continues. So basically, it takes money to make shit. And if there's money left over, it goes back to the person who made the investment, not the product. That's just the world we live in. The reason this is an important starting point is because Marx made certain assumptions and predictions about what would happen when those with the money accumulated way more capital than the people making the goods or performing the services. See, he believed that it would lead to exploitation and social imbalances. On the other hand, capitalists don't care because they believe in the risk-reward theory that the person putting up the money deserves more than the labor component. Labor gets to come along for the ride and they should just be grateful. So this is super basic stuff, right? Sometimes I think, though, that people forget that Marx wasn't some figure from antiquity. He was writing during the time of Lincoln, just to timestamp this discussion. So forget about the political systems that surround the debate, the argument over who decides how capital is deployed, who owns the means of production, who deserves the distribution of profit, and how we order society around these big questions. It is still a timely argument in that it's only 150 years old. We're still making this up as we go along. Hey, we're in the final days of our spring Fund, Friend, and Hellraiser period and greatly appreciate all of the support from new and old members alike. So remember to like this video, subscribe to the channel, and hit the bell to be notified of new drops. You can also sign up for our free weekly newsletter, the fastest growing progressive newsletter in the country. No paywall, completely free. It has news items that you might have missed, an original essay, book and podcast recommendations, an economic chart of the week, audience feedback, and more. So go to UNFTR.com to sign up today and be on the lookout for the launch of our 5 non-negotiables of the left platform next week that has downloadable and shareable assets, information about the platform, and ways to get involved to amplify our demand to take over the Democratic Party with truly progressive ideas. That's UNFTR.com for all the things. Now back to the episode. Now, along the way, some great political and economic minds have been trying to figure out the best way to settle these disputes, and certain predictions have been altered over time through lived experience. The one I want to draw your attention to, because it holds great relevance in this moment, is an idea put forward in the 1990s by an economist named Giovanni Arrighi. Arrighi built on Marx's total circuit of capital theory by examining certain periods that were dominated by the great capitalist powers, so the Iberian powers, Netherlands, UK, and US. He noted that they all follow a similar trajectory in 3 distinct phases. The first is called the material expansion phase, where manufacturing and production is growing. Then at a certain point, the economy moves to a service-based economy because manufacturers will move the production base away from domestic to foreign markets where labor can be more easily exploited. He calls the final stage the financialization phase, where profits begin to decline, the service base erodes, and capital seeks return through financial markets and increasingly risky and complex instruments. So, in order, the base of a capitalist economy over time will move from manufacturing to service to finance. Now, this very much tracks with a Marxian analysis as well. Great. Not everyone agrees fully with his assertion that this represents the inevitable decline of a hegemonic power or that it's necessarily the last chapter. Nevertheless, there is generally consensus that the phases themselves are pretty accurate and that the United States is indeed in the financialization stage. So now, let's put that in real terms over the past few decades before we talk about what Trump's team is attempting to accomplish. In the post-World War II Bretton Woods era, the United States emerged as a hegemonic global capitalist superpower for two reasons. The first is that the wartime economy laid the foundation for a modern industrial economy with wide labor participation. This is distinct from the early stages of industrial capitalism in the 19th century, which was immature and rapacious to the labor class. We were still very much an agricultural-driven economy, though the seeds were certainly planted for what was to come. The second piece was the reordering of the global financial system on the strength of the US dollar. The Bretton Woods system viewed the United States as the most stable economy in the world, so it made sense to tie the international monetary system to the value of the dollar with gold as an underlying valuation. The multitude of moving parts and innovations that stemmed from Bretton Woods were all tied to this single invention. So if we're going to use Arrighi as our guide, this was our material expansion phase, which lasted through the 1990s. Now, one of the hallmarks of this era was a strong labor market with positive economic mobility and capital expansion, especially when Nixon took us off the gold standard and allowed the Treasury to flood the market with dollars. Nixon didn't necessarily divide the pie differently, he just made it bigger. Now, Marx believed that the capital class would increasingly exploit labor and that worsening conditions and inequality would cause the working class to revolt and ultimately take back the means of production. Again, an oversimplification. But theorists as early as Rosa Luxemburg correctly predicted that capital would simply flow out of domestic markets and begin exploiting labor in other markets. This would lead to the dislocation among the working class that would ironically prevent them from rising up. And that's exactly what happened, which brings us closer to what Arrighi describes. The increase in capital and the growth of foreign markets and favorable trade agreements gave U.S. firms access to labor in other countries beginning in the 1970s. So if we think about the exploitation of labor through the 70s and 80s, through union busting and the rise of inequality through Wall Street returns on complex financial instruments, through real estate and the buildup of non-union sectors, we can see the transition from material expansion to a service-based economy. The Reagan wing of the GOP and the so-called New Democrats, personified by Bill Clinton and Al Gore, thrust us into the service economy stage by offshoring manufacturing. Wage protections started to dissipate as unions became less relevant. Workers were separated from production lines, and financial investment returns began growing faster than the real economic base of the country. The rise of Chinese manufacturing, meanwhile, and trade agreements like NAFTA, in conjunction with fewer and fewer labor protections, sealed the transition in the 1990s. Now, manufacturing might have been happening elsewhere, but new opportunities emerged domestically, like the growth of intellectual capital and tech in Silicon Valley, global headquarters setting up in U.S. cities, warehousing and fulfillment centers, finishing techniques that required highly skilled labor, service centers, and so on. But from the dot-com bubble through the financial crisis, the aughts were nothing short of a disaster for the working class in the United States. The manufacturing jobs left here at home were being rapidly automated. China's GDP was growing at double digits. And something called business process offshoring, or BPO, began to take hold with the growth of the internet and foreign-based customer support centers. The higher end of the middle-class jobs, derided by many as PMCs or the professional managerial class, and the wealthy continue to get ahead because of the returns on the capital and the growth of the wage base. But the middle class and the working poor started falling behind. At the same time, The deregulation of the 80s and 90s paved the way for the creation of complex financial instruments and leverage in the markets like mortgage-backed securities, something I'll return to in a minute because it's really important to get this down. So, the confluence of these trends, bringing us from one phase to another, has led to the current financialization phase. Outside of the energy sector, which is the most robust export market that we possess, the United States economy is wholly dependent on the financial markets, on things like intellectual property and real estate. And as we've talked about many times before, the prime age labor market of U.S. residents between the ages of 25 and 54 are still gainfully employed. But outside of that center, there are tens of millions of people who exist on the periphery of the high-functioning economy. Older Americans living on Social Security and savings, with some augmenting with part-time work. Large swaths of younger Americans are participating in the gig economy. They're cobbling together bits of continuing education, and some are just living off their parents. So when Trump says that the economic downturn is all Joe Biden's fault, that's where the kernel of truth comes in. Since the mid-1990s, it has been the official policy of the United States to offshore manufacturing jobs and to financialize this economy. So to the extent that Biden was in office as a senator throughout, as vice president under Obama and then president, he's not wrong. But the reality is that the fundamentals of the economy that those in the domestic and international financial sectors value were stable under Biden. Now understand what I'm saying here. I'm saying that under Biden, things were continuing to deteriorate for the working class, but that the middle and upper middle class and the wealthy would have been stable. We were mid-expansion in a normal capitalist market cycle, which meant we probably had a couple of more years to go before the next official downturn. What Biden and his team were betting on is that the long-term investments made in the two major bills would have taken root by then and officially stimulated and artificially stimulated the economy without having to resort to massive interventions that we've gotten used to. So that was the warning flag that people like me were raising at the time, essentially saying that if Biden didn't do something in the interim to lift up the bottom rung of the economic ladder, then the Democrats wouldn't be around to see it through. Donald Trump would just become an inevitability. So if you want to take a generous interpretation of the Trump agenda, here's what they were banking on with the trade war. Because they're stupid. To understand how Trump overplayed his hand, you have to look at the cards he's holding, as he likes to say.
You don't have the card.
He thought that we could threaten the world with tariffs, and that by doing so, it would bring in a ton of money and bring nations back to the negotiating table to make better deals so he could eventually take off the tariffs. These goals are totally incongruous. You see, Trump said he would bring in so much money from tariffs, he could theoretically eliminate income taxes on the middle class. He actually said that. But that the world would be so terrified, they would come to the table immediately and make better trade deals so he could take off the tariffs. So when people pointed out to him that you can't actually make better deals because we're bringing in goods that we don't have under agreements that we negotiated, he made it a national security issue. This is how we secure the border and stop the flow of illegal immigrants and fentanyl. And when people pointed out that immigrants aren't coming anymore, and that the majority of countries he tariffs don't move illicit drugs, he later declared victory and started backing off the tariffs, except for China, which I'll get to. So if the tariffs come off the other countries and China basically called his bluff and stopped sending stuff here for us to tariff, then we basically blew a hole in this whole I'm going to make so much money from tariffs that I can get rid of taxes on the middle class thing. So this was really all about China. So let's talk about it. The number one thing that we export to China is energy, through oil and gas primarily. China, on the other hand, exports minerals, electronics, manufacturing parts, finished goods, toys, makeup, building materials, nuclear reactor components, basically everything. And his answer to that was,
Somebody said, oh, the shelves are going to be open. Well, maybe the children will have $2 instead of $30.
Here's the thing about our imbalance. The energy we export is fungible, meaning they can get it from anywhere like that. The shit we get from them, on the other hand, is not. That's why you see new orders and shipments plummeting. In other words, he never had the cards, and everyone knew it but him. And we just lived through what it's like to completely reorient a supply chain after COVID. Not only did the initial shock generate inflation almost immediately, it wasn't transitory. It was persistent. We're still living with it. And it took almost 2 years to straighten out the snarls. That's why the Apollo reports look like that. You see, we're already fucked. It's predestined. He did it. He fucked around, and by the summer, we're all going to find out. In the meantime, the bottom rung of the economic ladder was never tended to, and government layoffs have already made it more difficult to access key government services. The bottom is falling out. As we've illustrated recently, the impact is already being felt in the subprime markets as loan defaults and late payments are on the rise. Now, by subprime, we mean people who use debt to purchase things like cars and homes but pay higher rates because they have lower credit scores. But big purchases aren't the only things being affected by the American credit crunch. A new survey from LendingTree shows that the increasingly popular buy now, pay later, or BNPL loans are heading into troubled territory, with a quarter of these borrowers using loans to buy groceries. Even more troubling, 41% of BNPL borrowers reported making late payments within the last year. Okay, so that's where things stand. So there's no going back. We're screwed. But that's not what's keeping me up at night. This is just what we can see. The macro take that I'm working through at the moment is like nothing I've ever seen. When you line up what's happening in the financial markets and layer in the Federal Reserve's policy options, the impending tariff outcomes, and slumping global demand, it paints an ugly picture. But there's one thing that I'm actually losing sleep over that I cannot pin down for the life of me. Leverage. One of the things you'll hear about on the financial channels is how firms are delevering. This is a negative signal in and of itself because it means that large firms, investment banks, and hedge funds are de-risking by limiting their exposure to riskier asset classes. Fine. That's easy to understand. But this is only in the market that's visible. There are hedge funds that run leverage into the thousands. Yeah, you heard that right. There are funds with 50 to 2,000 times leverage on their cash base. Now, these are the real gamblers, and their owner-managers have nest eggs and offshore accounts and couldn't give a flying fuck about the effects of their hedges on the rest of us. So that's the invisible piece that I'm struggling to wrap my head around. The other is the off-book overnight settlement market, which has some of the same players in it. There's something called a repo market, which is just a liquid clearinghouse for overnight trades to make sure that everyone has the money to cover what they bought and sold that day. Then there's the off-book or quote shadow repo market that exists just to the side of it. These are the mystery puzzle pieces that have taken down the financial system before. So follow this thinking for a second, and then I'll bring in the Fed piece. There are institutions making bets on the economic system that are leveraged to the hilt, and we can't see many of them. Up or down, when they make bets, they have to clear funds. Central banks and investment banks that put up the money to clear in the repo markets are all delevering. The world is selling off our securities, which is what funds our central bank outside of taxes. And Republicans are twisting themselves in knots to cut taxes on the wealthy in the one big beautiful bill, which Trump just released, by the way, so I'm digging through that right now. Tariff revenue won't be enough to offset the loss of tax revenue if they cause a slump in demand. Add these together, and if everything blows at the same time, it's 2008 all over again. Except in 2008, the dollar was still the most stable, revered, and valuable commodity on earth. You see where I'm going with this? So even though it was our reckless behavior that nearly brought down the global economic system in 08 and 09, everyone believed that we would figure it out. In the short term, people were banking on Fed intervention, something referred to as the Fed put, bailout. In the long term, the world bet that we would diagnose the problem, fix it, and regulate it going forward. So when the dollar fell and the 10-year Treasury yield went up last month, it signaled both a weakening in our actual economy and everyone's faith in it. So that brings us to Jerome Powell and the Federal Reserve and the tools at its disposal. They can raise or lower interest rates. Trump would like them to lower them immediately. That's why he was threatening to get rid of Powell, which caused another fucking market meltdown. But the Fed typically uses interest rates to spur the economy or slow the economy. So conventional wisdom holds that Lower interest rates boost the economy through refinancing and new borrowing to spur investments. But this actually contributes to inflation because it tends to heat things up over time. And since Trump just guaranteed an increase to inflation through his tariffs, that's kind of off the table as a useful tool. Not to mention, credit is going to be so tight, it doesn't matter how low rates go. Banks aren't about to loosen their standards when everyone is predicting a tariff-driven recession. So that leaves the Fed balance sheet. Now, during the financial crisis, they did everything all at once. They expanded their balance sheet by issuing a massive amount of debt to raise capital, and then they purchased toxic assets from the banks and held them on their balance sheet. They put so much free money into the market for so long, the big banks came out ahead on arbitrage alone for a decade. For the past several years, however, the Fed's been trying to bring things back to normal to achieve the, quote, soft landing that you've probably heard over and over. A little bit of inflation, a little bit of unemployment, normal interest rates, no more free money, and more controls. And then along comes Dr. Orange Von Fucknugget with a bundle of Acme dynamite to light the whole goddamn thing on fire. I mean, it's unbelievable. Now, before I explain the final opaque threat, understand that the reason the Fed isn't panicking right now is because Jerome Powell came out and basically said, I get it. Things aren't great. We're worried too. But the downturn, the sell-offs, de-risking, and de-levering isn't a bad sign in the eyes of the Fed. You see, in their eyes, it's a rational response that signifies that the markets are functioning.
Some people believe the Fed will intervene if the stock market plummets, the so-called Fed put. Are they correct?
I'm going to say no with an explanation. So what I think is going on in markets is markets are processing what's going on. And, you know, it's really the policies, particularly the trade policy. And really the question is, where's that going to come in? Where's that going to land? And we don't know that yet. And until we know that, you can't really make informed assessments that would still be highly uncertain. Once you know what the policies are, it'll still be highly uncertain what the economic effects will be. So markets are struggling with a lot of uncertainty, and that means volatility. But having said that, markets are functioning, you know, conditional on being in such a challenging situation. Markets are doing what they're supposed to do. They're orderly, and they're functioning just about as you would expect them to function.
Now, the financial crisis and COVID, those were examples of complete market dysfunction because liquidity disappeared. In other words, there were more people looking to get out than get in. It's a classic run on the banks, but global. When the dollar and the 10-year went upside down for a couple of days, that was a signal, and why everyone, including Trump, panicked. But when things calmed down and institutions steadily worked through their trades, it showed that there was enough liquidity in the system to manage the upside and the downside activity. So, okay. But if you listen to nearly every financial analyst that covers the market right now, you'll hear the same thing over and over. They keep talking about the Fed put and saying, at some point, the Fed's going to have to intervene with liquidity when things go upside down this summer. I mean, that's literally everyone right now. But here's the problem. The problem lies below the surface in those repo markets I just told you about. Now, there have been a couple occasions when the Fed had to step in to provide liquidity in these repo markets because there wasn't enough money to cover settlements. You had the Great Recession and the March shutdown in 2020, but those are the obvious ones. The one that spooked everyone happened on a random September day in 2019. A sudden spike in volatility, combined with liquidity demands, which was stemming from corporate tax filings and new treasury issuances, caused the repo markets to just collapse overnight. Are the pieces starting to come together yet? See, the repo market is the iceberg below the surface. So we know the tip of the iceberg. That's visible. That's the open repo market that's visible because it's controlled by the Bank of New York Mellon, JP Morgan Chase, and the New York Federal Reserve. Those are the big three. But it's the off-book settlements, the off-book shadow repo institutions that operate something called a basis trade. That's what isn't visible. And here's how that works. Let's say I'm selling something for $100, but the cash won't be available until tomorrow. Now, I could go to the repo market and get $98 tonight from, let's say, the New York Fed, but I can get $99 tonight from a hedge fund. So great. $1 to settle this all out. It's just the price of doing business. Now, the hedge fund is taking that buck for the trouble of putting up the money so they get to wet their beak. But here's the thing. $1 isn't much of a business. But if they do that trade 1,000,000 times every night, now we're talking. It's just an overnight risk, so it's a pretty good business as far as being a sure thing because your customers are always going to come through, right? Right? Now, they might have the money to do this a couple 100,000 times, but 1,000,000, that might be more than they have. But because they have such a good thing going, they convince another lender to give them money at a low rate so that they can do 5 times the amount of business that they can actually afford. So now we have some guy giving another guy money so he can give another guy money. Everyone taking a piece of that dollar up and down the line. And just in case something goes bad, there are 2 fail-safes. One is the Federal Reserve, like in our 2019 example, or during March of 2020 when it flew in with $100 billion in a single day to prop up the settlement market when there was a sell-off. So if everything suddenly goes tits up, the Fed is the only one that has the dough to fly in and save everything. Now, another is insurance. So you remember AIG during the financial crisis, the company that insured all the shitbag mortgage-backed securities because the rating agencies didn't understand what was in them, and how the government had to bail out the insurance company and the financial institutions at the same time to keep the global economy alive? So now you have a party, a counterparty to the counterparty, all backed by an insurance company and the Federal Reserve as a last resort. All dependent on the belief among nations and institutions that the United States is creditworthy, the dollar is stable, and our leadership is sound. In other words, an entire economy built on faith. If the economy seizes up as the shelves run dry, supply chains snarl, inflation grips the consumer, and layoffs build, the Fed's usual interest rate tools won't work because we'll have stagflation already. And if tariffs aren't bringing in money and tax revenues decline because he cut taxes on the wealthy and we're in a recession, the Fed would theoretically have to release more money into the economy by raising debt, which will widen the budget deficit. And when all of these events spook the market and there's a rush to liquidity, the Fed would theoretically have to step in here as well, the aforementioned Fed put, because we have no idea how much leverage is in the shadow repo market. Not even the Fed can see the whole iceberg. So when someone like Scott Bessent talks about reordering the global financial system, never has someone been so right by being so fucking wrong. There are a couple things to bear in mind as I wrap up here. First off, job one is to make sure they don't get away with blaming the prior administration. All of the top-line data coming into 2025 were relatively strong, though it certainly left the bottom wage earners out of the equation. The rapidly approaching global crisis is entirely Trump's doing. Second, don't put yourself in harm's way if you're a non-seasoned investor looking to jump into the markets. We're in uncharted territory, and the big guys have the wallets and the risk tolerance to bet on the crash. You do not want to be on the other side of them. Bitcoin and gold, they're all the rage in the trading world right now, so it might be tempting, but just don't. Be small, stable, and nimble. And of course, remember our mantra, the market is not the economy. The investor class is going to fuss about and be noisy. Let them. All that matters is your personal health, your ability to pay your bills, and to keep your head about you when everyone else is losing theirs. But the last thing I want to say is don't be afraid of having big conversations about things like systems and isms. You know, Democrats like Alyssa Slotkin have been criticizing Bernie and AOC for their Stop Oligarchy tour, saying that words like oligarchy don't connect with the average voter. Just stop. Stop patronizing everyone like you're so fucking smart. The voters understand way more than you think they do, and that's why they're packing arenas. The main takeaway here is that Trump is the accelerant on top of a capitalist brush fire that has been burning for a long time. People are being left behind. They deserve an explanation. And we can have grown-up conversations. And as I've said before, These establishment Dems are an even bigger impediment to taking back the country than the transparently destructive GOP. Now, we're going to talk a lot more about that in the weeks to come as we push out our 5 non-negotiables of the left initiative, challenging progressives to make some demands. But for now, get small, but think big. Don't let the bastards get away with the blame game. And bone up on your systems and strategies, because if Arrigo is right, and we're in the final stage, then the opportunity to shape what comes next belongs to us. Here endeth the lesson.
This is the story of a political pundit who looked at the world around him and just said, fuck it. Gives the middle finger to authority and says, kiss my ass. But instead of a revolution, he started a podcast. Just what the world needs. Started a podcast. Another basic white guy who started a podcast. But it's fun because he curses all through the podcast.